Everyone knows smart money concepts work. The question is, why do some traders print while others consistently blow accounts? You show up every day, you watch price, you take trades, you might even journal, but you're not seeing the results you had hoped for. And instead, you're probably bleeding out money. The problem isn't the concepts. It's either the work you're not doing or the work you're doing completely wrong. If you spend just 60 minutes a day doing this instead, you'll be unrecognizable in 6 months. And it starts with this one habit, backtesting. Most people overconsume and under-review. Then they wonder why they feel confusion when it comes time to execute live. They hop from one model to another, trying to find the perfect strategy instead of learning why price moves, then building a model around that. How do I know? Because that was me. Early on, I was doing what most traders do without any guidance, chasing every strategy under the sun, watching every ICT video I could get my hands on, and spending hours on the chart, even if it meant sacrificing my health, because I just had to make this work. But nothing was working. I had no repeatable system, no data to learn from, and didn't even know why price was doing what it was doing. After losing more money than I could stomach, I learned effort does not equate to results. I had to treat this like a real profession and lock the fuck in. So I started blocking off 60 minutes to backtest every single day. No excuses. That was the turning point. That's when I learned to trust my strategy, stopped reacting to price, and started anticipating. That's when consistency wasn't just a dream anymore, it became my reality. And I want to add, this is still something I do as a full-time trader and entrepreneur. No matter how busy life gets, I still make time to do this every single day. Now, let's get something straight. Most traders are doing backtesting completely wrong. Using market replay to scroll through 1-minute candles 6 months back is not effective backtesting, and it's a reason why most traders stay stuck even though they're working hard. I'm going to walk you through step-by-step how I backtest so that by the end of this video, you'll have the exact framework that took me from consistently blowing accounts to consistently profitable. Step 1, establish your higher time frame bias. Starting from your weekly and your daily chart, determine is the market bullish or bearish. To do that, you simply want to look at where is this market drawing to, higher or lower. I do make this available every Sunday for free. If you don't know how to determine higher time frame bias, we got you covered. Step 2, refine through the time frames. Once you start with your higher time frame bias, you then now have to drop down into your hourly, 15, 5, and 1 minute. It's really easy to get lost as you refine, which is why it's very important to again start from the higher time frame. Higher time frame price action dictates the lower time frame. Then as you're refining, frame a narrative. For example, if the market is bullish and it's reaching higher on the daily chart, what's it likely to do first on your 1 and your 5 minute charts? Drop down into a discount inefficiency or drop down into sell stops, or smart money to buy to then distribute to our higher time frame profit objectives. This is how you go about framing a narrative for how price is going to deliver to your higher time frame objectives. Now for step 3, you want to identify key signatures on all time frames. So as you're looking at the weekly, the daily, the hourly, down to your 1 minute, what signatures are you seeing? Is order flow, market structure, bullish or bearish? Those are things you want to start identifying, because then when you go down into your lower time frame charts, you're going to have clarity instead of being lost looking for patterns like most do. The great thing with the logic we use, it repeats every single day. The only way you get the confidence to actually execute, put your money on the line, is seeing it hundreds of times every single day. Step 4, log the trade. So now you've determined your higher time frame, you've refined down. When you get to your execution time frame, you now want to log the trade, where you would have entered, where you'd place stop loss, where your take profit would be, and how you would manage the trade. Again, it's different for everybody. Some people's execution time frame may be a 15-minute chart, while someone else's execution time frame may be a 1 minute or a 15-second chart. This depends on your style and your personality. This is how you overcome fear and hesitation. I've spoken with hundreds of traders that have models, but are scared to execute. Wait for confirmation, the market runs off, they chase it, and we wonder why we're in this cycle of continuously blowing accounts. You have to get confident to execute on your model, and that only happens by seeing it hundreds of times. And now for step 5, reflect. All time frames. What did the higher time frame do? How did the lower time frame deliver within the context of the bias? And you want to look at this through the perspective of a smart money trader. Meaning, again, if the market is bearish, we want to see the market do what first before dropping? Run higher first at a specific time. right? These are things we want to start studying to get confidence with narrative as it's printing in real time. Now I'm going to go into my Notion and show you an example from yesterday of what my backtesting looks like. I use Notion for journaling and backtesting. If you want a full walkthrough of what my journaling looks like, comment down below and I'll make a full tutorial. All right, now getting into the Notion here, we can see my Notion template. We're going to be using Tuesday here as an example. Going into the backtesting logs here, starting from the higher time frame, starting from the weekly chart. So we can see here, we're seeing clear bullish order flow, down close candle supporting price, and the market's trading to and through inefficiencies. So we can see this is an inversion fair value gap here, one we've been watching for the past few weeks. We can see we're above it, using it as support, which gives us a weekly bullish bias into the previous week's high here. Through that, we have the all-time high here, but again, we're just using this for intraday targets. So you can see the market's likely to expand higher, so this sets the tone for what we're going to look for as we refine through the timeframes. Working down into our daily chart here, we can see the market recently retraced into the recently created range, took out this low here. When we have sell stops taken or a swing low taken in a buy model or when in a buy program, when the market is bullish, that is going to create an intermediate term low. From here, we see a bullish order block created, extend that through. The market drops and creates a swing low inside of the bullish order block. What a swing low is the 3-candle pattern with candle 1, 2, and 3, with candle 2 having a lower low than candle 1 and 3. When you have that swing low forming with 3-candle pattern, it gives you the bias for candle number 4 for a high probability bullish expansion. So we have a bullish daily bias for this candle here because we're bullish and we saw a swing low inside of an order block, and we can trust that candle 4 is likely to expand. Where to? That's what the daily chart is for. We have the previous day's high here. That's going to be the initial draw. Through the previous day's high here, we have the 50% level of this wick. So consequent encroachment or 50% of the wick. And then through that, we have the previous week's high. Again, it's not important that all these targets are delivered. It's important that you understand where the market is reaching for it so that when you go into the lower time frames, you're not getting lost pattern trading. Further refining now into the hourly chart. Very important to have your higher time frame reference. This is where things start to get shaky for traders that haven't done this for a long time. You completely lose sight of what the weekly and daily is telling you, and you drop down to the lower time frames, and again, you completely lose sight of what's going on. So that's why I have here the power of 3 AMD, or accumulation, manipulation, distribution of the daily chart. So you can see accumulation, manipulation, making the low of the day, expanding, closing off the high, which is just simple open low, high close on the daily chart. So you see here the market drops at midnight. We drop, make the low of the day. This gap here, we then close above it, use it as an inversion fair value gap, attacking the previous day's high here. This hourly fair value gap back here, and then the consequent encroachment or the 50% of that daily wick, gravitating towards this previous week's high here. So further refining now down into the 15-minute chart, we can see clear accumulation, manipulation, and then distribution throughout the rest of the day. 70% of the time, if you know what you're looking for, London will make the high or low of the day. So in this case, the bias is bullish, so we can anticipate London making the low of the day. So you see London drops, takes out sell stops, expands higher. And then what I'm noting here is just my internal dialogue going into the session. So 9:30 to 11 is when I'm doing my trading. So here I'm mentioning that New York opened near my drawn liquidity, which is the previous day's high here and these levels. So because of this, I had to wait for the market to drop below 930 to price in a discount for me to go long after we had a large run higher in the pre-market session. So whenever we see a large run between London, which is 5 a.m. to 9:30, that's the pre-market session. Whenever we see a big run during that time period, it generally makes me more patient going into 9:30 because we've already ran a lot, and it generally makes for a more difficult morning session. So what I wait for is for 9:30 to price in a discount. What does that mean? I want to see a drop below the 9:30 opening price into a key level. In this case here, we have the down close candle, which is a bullish order block, and that prices in the discount for then me to trust going long into the previous day's high, into the hourly fair value gap, and then again, the consequent encroachment or the midpoint of that daily wick. And then we can see again, open low, high close. Can't reemphasize this enough because then as traders start to go into the 5-minute and the 1-minute, we completely pattern trade. And then you hear ignorant people saying things like 1 minute is noise, or you can't trade a 1-minute chart. And it's just because they don't know what they're looking for. Dropping down into the 5-minute chart now, here we can see even more clearly, accumulation dropping in London, making the low of the day, market reversal profile using a turtle soup, below the midnight opening price. Once we get to 9:30 though, again, as we mentioned, we're already really close to this previous day's high here, and we had a large run in the pre-market. Generally, that's going to make me patient and wait for exactly what I want to see. And what I look for is very simple. If I'm bullish, I want to see the market drop at 9:30, below sell stops, and that's going to give me an easy trade into my targets. So we see here sell stops cleared, setting up the range expansion into my higher time frame drawn liquidity. So if I'm bullish, I want to see a drop below that. That's what I'm annotating here. And it's below the 9:30 opening price. And then we see the market expanding higher into previous day's high, the hourly inefficiency, and then the daily midpoint of the wick. Further refining now into the 1-minute chart, we've now done the 5 steps. We started from the higher time frame. We've refined throughout the time frames. As we're doing that, we're noting our observations on each time frame, and now we're looking for the model. Again, you have to go through the first 3 steps, because if you just go right into the model and you jump right down into the 1-minute chart, it's going to look like noise. The way you have clarity in these lower time frames is refining top down, because again, the higher time frames are going to dictate the lower time frame price delivery. So if you understand what the higher time frames are doing, it makes the lower time frame easy, because now you know what you should be looking for. So we see here 9:30. So we had sloppy market structure, and we had decoupled markets in the opening range, which is from 9:30 to 10 o'clock. So I decided to wait for the market to clean up after the high impact news at 10 a.m. So whenever the market's sloppy at 9:30 and we see all this type of trash price action here, no runs on liquidity, no clear market structure, no clear order flow, I will wait for the market to clean up. So what I'm looking for is for the market to run against liquidity. So once we have an opposing liquidity taken, why would this be opposing liquidity? Because everything we already covered. Top down, we're bullish. So we want to see the market drop into opposing liquidity first. And once that liquidity is taken, then I can go in and trust my buy models after the intermediate term low of the session has been priced in. Now, this is how we ring in narrative. So bias is where's the market going on the weekly and the daily. Narrative is how is it going to get there. We know markets don't open and run straight higher. We expect the market to open, drop below the opening into sell stops or a discount inefficiency. What that's going to do is price in a discount or cheap prices for smart money to buy. And then they're going to permit it to trade into the targets that we're looking for. So that's the difference between bias and narrative. Bias is where's the market going. Narrative is how is the market going to get there. So you see the market drops below 9:30, creates the intermediate term low of the session. Once we see that, we then create an inversion fair value gap here, which we close above. Traditional fair value gap here inside of a bullish breaker. That's where I was doing my buying, aiming for previous day's high, and this hourly gap in here. And we can see the market trades higher into the rest of the day, attacking the midpoint of that daily wick. And then we can see here the hourly fair value gap turns inversion fair value gap. Why is that? If the market is bullish, we're not expecting it to hit this gap and sell off. We want to see it trade to it and through it, get to that daily wick, and then we want to see it use it as support. And look how the body's perfectly stopped, turn on a dime, using it as an inversion fair value gap. Now to show you where the rubber meets the road, I want to show you some of my journal logs that I use this day, because this is the money-making shit. So now looking at the 1-minute chart here for S&P, 1 sell stops were taken. We also had an SMT with the NASDAQ, further confirming higher prices. As soon as we closed above this inversion fair value gap, that was my trigger to go long inside this breaker. Covered one here in the previous day's high. And then I had another one set to take off inside the low of that hourly fair value gap. And this is what I'm journaling and reflecting on. So we see here the market stopped 1 tick short of my low-hanging fruit limit order at the low of the hourly fair value gap. And then the market retraced to my stop that was in profit. We always want to keep our backtesting and our journaling positive. So this was a great opportunity to reinforce the lesson of letting the stop loss breathe if I am looking to lock in these bigger price runs. I am still pleased with my ability to manage the trade profitably and lock in the gains to wrap up my non-farm payroll week trading. So nothing's negative. I'm not saying I'm the biggest dumbass in the world because it didn't hit my limit order, right? I'm content because I was still able to manage it profitably. I didn't get my best limit order, but at the same time, I learned from it. And it's something I say frequently. If you're trying to hold for big price runs, you cannot suffocate the stop too tight. So I should have had my stop below this intermediate term low here, because what you just learned in this video, if the market's bullish, we trade below a low. That creates an intermediate term low, and that's why that low should not be violated. I had my stop a little too tight in here, took me out. It happens. But again, we want each reflection to be positive. So here's just some of my observations that were occurring during the session. I waited patiently during the opening range, waiting for clarity in the market structure and institutional order flow, since the markets were decoupled at the open. So we had decoupled markets, really sloppy market structure, and I don't like to trade in this. I like to wait for the market to get clear. So once the sell side liquidity was swept, that was the discount I needed to see to pull the trigger, aiming for, again, the previous day's high and that hourly fair value gap, which they left conveniently intact for me to take profit. So as the market's running higher, 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 but leaving this high intact, I knew that was going to be used later on. After they dropped it into sell stops, then I can confidently go in, trust my buy models, and ride the market into my targets. But I want to show you guys an example that wasn't perfect, because even though I'm able to see all these things, even though I'm able to see where the market's going, sometimes my execution just isn't on point, and that's going to happen. But I wanted to show you where the rubber meets the road. This is not just backtesting for the sake of me wanting to sound smart or tell you should be backtesting. This is the money-making shit. For the next month, at the end of every trading day, I want you to set a timer for 60 minutes and do exactly what I just outlined in this video. If you do this for the next 30 days, you'll notice a change in your ability to read price action. But give it 6 months and you won't recognize the same trader who started. One will second guess every candle. The other is patient, executes with conviction, and knows exactly why they're doing what they're doing. Which version do you want to be?